called like a crystal ball award, but he's won it like 3 times. So a lot of economists, he's pretty very well respected in that sense. So like we get a lot of great insight from him. A lot of the mortgage industry does. Yeah.
Okay.
Okay, so some of the other, this is the Fannie Mae like housing confidence survey. It was published in November, and so this is the problem that as realtors and mortgage partners, like we should be, I think it's important for us to collaborate and to try to solve, because overall, consumers frightened. They're reading these headlines. Some of them are not. After they read, like they're not calling us back. So it just, we're just combating this whole, counteracting with the news. So, you know, just meeting up like this and just kind of working together, we can really get them to move over from that conjecture to certainty. So here, like this is there's definitely a correlation between like inflation and like the 30-year mortgage rate, right? And basically what this chart is showing here is going back to like January 2018. But we're looking here at this, when you look at this like QE period, this is a qualitative easing. I'm sorry. So that's when the Federal Reserve, they rigged the game, and up until that point, you could see that correlation there, right? Where when the qualitative easing period, during that period, the interest rate it's kind of stays stagnant at like 3%, right? But when that ended, the CPI is shot up, and then what the interest rate was doing, it was trying to catch up. So that's what happened. Like all of a sudden, in a short period of time, because of that catch up, because everything has to, it has to come back to where it was before, right? So it has to try to correct itself. And so that's when we saw that interest rate jump, and then everything kind of like slowed down for us, right? But as you can see here, as everything kind of corrects itself, you can see where like it's starting to follow that course again, right? So as the CPI is kind of normalized here, and then it kind of crossed over again, and then we're kind of going back into that, into that historical, where that you have that like spread between the inflation and the 30-year mortgage rate. Okay, so this is like important to know, because you hear sometimes people say, hey, I'm worried about the next Fed meeting, they're going to raise the rates 0.5%, and it's just to help them understand that, hey, it's not the federal funds rate that drives the mortgage rate, it's inflation, right? So when we think inflation will peak, and why do we think inflation is going to come down, right? So that's the question. So it's really important for us to understand that and to be able to explain it, because mortgage rates, it's the primary one driver of affordability, right? It drives the whole the housing market, economy, and things like that. So here, like we look at the CPI, right? When you look at how they calculate inflation is they add up all the inflation readings over the past 12 months, right? And they come up with like a combined annual year-over-year inflation rate, right? So right now, like the core CPI is currently at 6% year-over-year, which means inflation has gone up 6% during that period. So each month when the new inflation data is released, it replaces the previous month's data, and it affects the overall cumulative inflation rate, right? So I know it sounds really technical, but like if you just look at the if you see, like, for example, like we received a November 22 inflation print, is what they call it. It came out at 0.02, and that replaced the November 2021 print of 0.05, right? So it came down from 0.05 to 0.02, right? And then the previous month before that, we see October 2021 0.6 being replaced by 0.3. So you see the trend here, and then the December one, when this slide was made, the December number didn't come out, but it came out last week. So the December print was actually, it came down from 0.6 to 0.3. Okay. So right now we have a big opportunity because we have, like, the January print, we have February, and we're going to continue to see the year over year inflation come down, because when the new data comes out, it's going to replace these numbers from the previous year. Following?
Yeah.
Okay. So yeah, there's some real, like, opportunity here for the rates to drop even further, because it's gonna just, you can see the trend here. Okay. Now, the reason for the decrease in inflation is believed, because the decrease in the shelter costs, right? And specifically rents. Now, the rents make up about 39%, right? The shelter cost, I'm sorry, the shelter cost makes up about 39% of the core CPI. Okay. Now, when the shelter cost comes out, it comes out, it's a lag effect, right? So there's all the data. Um, it's about 4 to 6 months behind. So, like, last week, the shelter cost, the new number that came out, it was a little bit higher, but the overall rent and the it was lower. So, like, this is also going to, like, kind of correct itself. So this number, we believe it's going to continue to decrease as rents continue to moderate, and it's going to lead to, like, a decrease also in inflation. So this is another, like, major contributing factor to it. The shelter cost is a big deal. Let me just kind of fly through this here. So you see here, like, the CPI, the rent, the year over year, right? This shows that from the data from the apartment list is that rents have been, kind of steadily decreasing. Okay. All right. So just to kind of summarize, like, the prices have come down, right, across the board for, uh, you know, food, gas, clothing, and all of these are a part of the CPI. But shelter costs, because, like, of the data that comes out later, there's like a lag effect. So it's going to catch up, and eventually that will bring down inflation and bring better mortgage rates, right, for the year ahead. There's definitely a correlation, right, between the 10-year spread and the 30-year mortgage rate. So if you go back, like, this is data going back to 1991, right? So as long as, like, they've kept this data, there's always been a spread between the 10-year treasury and the 30-year mortgage rate of about 1.75 to 2%. So there's always, like, you know, going all the way to 1991, like, you can see, it's always been there, right? It always follows the 10-year treasury. And the reason for the increase here, right, when the spread all of a sudden is like 3%, is because when the interest rate jumped really high, what happened was, like, the servicing component of it, uh, it caused the what is it, basically, like, the servicing component, like, it lost value. So basically, everybody that when all of a sudden it jumped, um, long term, like, anything that's long term, you finance a long term, like a 30-year mortgage versus a 15-year mortgage, right? It's always uh is always more, is a higher interest rate, right? If you go, like, a 15-year mortgage, it costs, like, if you get a car financed, like, for a shorter time, it's always a lower interest rate, right? So when the interest rate jumped up, everybody thought that, okay, these loans are not going to last long, right? Everybody's going to refinance it right away. So that kind of you know made uh that kind of, like, messed with the numbers there. It increased the spread. But that too is also gonna correct itself, because that's all had to do with the quantitative easing and all that stuff. So we're not only do we think like the inflation is going to come down, right, which is going to bring down the mortgage rates, but this historical spread that we see here, it should bring the interest rates down once it corrects another like 1%. Okay, worse, like worse come to worse, right? It could be more than that, but that's what that's what the kind of the experts are projecting right now. Can you guys hear me?
Yeah. So are you
Okay.
suggesting that you think the 30-year mortgage rates for conventional conforming will go possibly less than 5% by the end of the year?
It's possible, yeah. So it like from all indications even if it's like doesn't improve like like drastically, it's gonna at least go down like 1%. It's gonna be like around 5%.
Okay.
Okay. So another reason, right, we think like that, mortgage rates are heading lower, right, is because of the condition of the consumer, right? And you can see by looking at these two graphs that the consumer is getting stretched. So if you look at like the credit card and revolving debt over the past several years, you see that like where it kind of peaked here. So the credit card that basically what happened was like this is right around the time when the pandemic started, right? So everything was on lockdown, so people couldn't really spend. So then the credit card and the revolving debt started to decrease, right? And once everything started, the economy started chugging along again, then you see how like the debt started to increase. Okay. um, Savings rate, same deal here, right? The savings went up during the pandemic, right? And then now savings are starting to continue to deplete. These two little spikes here, these are from like the stimulus, right, when we got money from the government. So that's the reason for this data here. But overall, you see as uh, you know inflation's going up, cost of things are going up. People are tapping into their savings, and then once the savings are depleted, now they're tapping into going into more debt, and that's like a perfect combination for like a recession coming if we're not already in one already, right? But if you look at these two graphs, right, it's just showing that the consumer's getting stretched, and at some points the credit cards are going to max out, and they're going to burn through all their savings, and when that happens, we're going to see more contraction in the economy, and the credit card balance was increasing, like now they're at really like at an all-time high, and the average interest rate on a credit card is just north of 19%, right? So as like the American consumers are becoming exhausted and they're maxing out credit cards, they're depleting savings, uh, they're no longer going to be driving the economy, and that's what's going to lead to a recession, which is going to lead to a decrease in mortgage rates. So here's another great historical data of recession, right? And this inverted yield curve. The inverted yield curve, like if you're not familiar with what that is it's not it's very simple. Like it's just basically the relation between like the long term, um, was it the 10-year bond versus the shorter term, the three month treasury. So when normally like the longer term should be higher value versus the shorter term, right? But when the shorter term investment is valued higher, then we're in an inverted yield curve, right? And if you look back, like since before 1985, each of these gray bars here, this is whenever this represents a recession. So if you look before right before that, this point here, this is when the yield curve was inverted. Okay, so inversion, recession, inversion, recession, inversion, recession, right? And right now, where we're at, we're like super inverted right now. So it's, nobody can predict the future, but if you look at the data from 30 plus years, it's very evident that we're heading into a recession. Okay. Sorry, my headset sometimes goes out. Like, you gotta let me know if you can't hear me all of a sudden. Can you hear me?
Yeah, we can hear
Yeah.
you. I think
Okay.
I'm not sure if it's necessarily correct. It's a perfect predictor. I think there's a high correlation. It works like one way. I think there was an inversion of the yield curve. Um, Let me see. Before each recession, but an inversion of the yield curve doesn't necessarily foreshadow a recession. I think there were more inversions of yield curves than actual recessions, but um, so I think you can kind of look at it in retrospect because I don't think there was a recession after every single inversion of the yield curve, but I'm not 100% sure about that. I just don't think it's a perfect predictor. um, Let me see.
Yeah, I mean, look, these are just to help us to try to educate our buyers, right, and our
Yeah.
consumers. So, I mean, it is, this is like, actual data. So, there's other ways that we could um, show, and we can, uh, let them know, like, okay, we have this data here, and then we also have, like, um, yeah. I mean, I understand what you're saying. There's no perfect way to predict everything, but I mean, there, we could look back at the history, and basically dispel like a lot of things that people say, because a lot of people are anchored to the recession from the Great Recession that happened, right, in 2000, 2006, 2007, and they correlate the recession to a housing crash, right?
Yeah.
So if you look here, right, if you go back even further, right, if you go back to the 70s, right, um, you see where every time there has been a recession, right, there's been a massive improvement in mortgage rates. Okay, so right here you have, like, in 1980, 16%. There was like almost over like a 3%, almost a 4%. No, it's like 3% improvement in the mortgage rates. You got like 5% here, 11 to 8.75. So just another, area that we could point to kind of predict, right, where the interest rates, where we think that they're heading. Um, so, why do we, the reason why we don't want to talk about the recession, right, is obviously because of the Great Recession. Um, but if you look at this here, housing, stays strong through recessions, right? Um, and we go back all the way, going back to, this is over 62 years, and we'll see that housing prices, as measured by, the S&P Case Shiller U.S. National Housing Price Index, right? Um, Typically, we'll see the value of homes is flat, right? A positive through virtually like every recession. Okay, even including the COVID recession, right? Okay, and that's because right now, except for the Great Recession, um, real estate's been pretty strong. Like, and the reason why is because we've had a incredible run of credit, right? Incredible run of the number of homes being built, and it was a very, very different environment at that time in 2006, 2008, than what we see today, right? Uh, okay, so you know, just to look at a few differences between where we were in the past in terms of like inventory and in previous housing cycles and where we are today. So this is the kind of the data I think that the buyers need to see. And this inventory, it comes from the National Association of Realtors, and it's the month's inventory, the inventory of homes for sale from the 2011s. Okay, so you can kind of see each year there's this like kind of this seasonal increase in inventory in winters, and drawdown in inventory in the summers, right? Um, and if we look at where we are with the inventory nationally, right? And as we're kind of at the end of 2022, we're only sitting on about three 3.5 months worth of inventory, right? So that was very different from the last housing crash, right? Um, and how did we get to those elevated levels at that time, right? From 2008 to 2011, and why do we have like so much less inventory today, right? And this is really something that nobody really understands. So here you see like the graph that shows the relationship between like household growth and the number of annual housing completions, right? So this data suggests that from 2002 to 2014, right, there was an oversupply of homes being built, right, and household growth, right. So in the way that they measure household growth is like for my family, if I have like three kids, um, when each kid goes to college, my household becomes all of a sudden four households, right? Once they reach that age. And here, like since at the 2006 time, there's household growth. So we had the most completions in history here. So we had oversupply here, and until we get all the way to like 2015, where this trend it kind of started to reverse, outside of like 2016 right here. But now you see here like we have the household growth exceeds the annual completions, right? So uh, th- there's it's very highly unlikely that a housing market can crash when there's undersupply of homes, right? So another like comparing between that time and right now, between the Great Recession, um, is very, very different because number one, right, during the Great Recession, right, you had 8 million job cuts, right? In the current housing cycle, we have none. Total payroll jobs increased from 100, we're at 153 million versus 130 million at that time. But the main things here are like this here, subprime loans. So at that time, there were subprime loans. Now you have to prove your ability to repay a loan, and it's very highly regulated, right? So there's because of that, mortgage delinquency, which was at 10.1% during that time, only 3.6% right now. Homes in foreclosure, 4.6%, and 0.6% now. And there was a lady at my church that like I guess she works at like Navy Federal, like the mortgage. Um, she was giving a lady advice on hey, what should I buy a house now? And her advice to her was, oh, you should wait until all these homes go into foreclosure, right? And she had no idea what she was talking about. So she's does mortgages, but she's also like buying into this whole thing of like, okay, we're going into a recession and it's gonna be like the last housing crash, and it can't be like further from the truth. So overall, right, market conditions suggest that home price moderation is more likely than a home crash. Okay. So this is the Case Shiller National Housing Index, right? Shows that over the last decade, homes values have increased about 150%, with 39% of that appreciation occurring rapidly over the previous 2 years. Okay. Um, so affordability is obviously, like, kind of to answer your question, Danny, like, affordability is the number one challenge in the housing market, right? As the interest rates go up quickly, and home prices were skyrocketing, right? So that led to a big slowdown in purchases. But if we kind of like put things in perspective here, so if we look at here, right, the affordability, right, in the housing market, it's going to improve, obviously, if the mortgage rates decline, right? But if we compare, right, if we look at last year, a loan amount of 400,000 at an interest rate of 3.5, okay, you're this year, we do a 440 loan amount, and you're at a 6.25 interest rate. That's an increase of almost $1,000 in the monthly payment. Okay. So with a 10% increase in home prices and a rapid rise in interest rates, right, you'll see almost $1,000 increase in payment, $913, right? So now affordability, right, includes income, and according to the ADP, the average household income in the private sector, excluding government, is about 9,000 per month. Okay, so people who stayed at their jobs, and this is all based on the ADP data, they saw an increase in about 7.6% of their income. Okay, and people who switched jobs, the switchers, they saw an average of 15.1% increase, right? So the averaging that out, you're looking at an average increase annually of about 9%. Okay, so when if you factor in, okay, their increase in household income, but we also have to be fair, right? We also have to factor in increase in gas, food, and services, right? So if only a 5% increase, right? So next year, uh, basically is just showing that, like, okay, their household income, and with the decrease in the when the mortgage rates start coming down, overall they're going to be ahead. So like if you kind of show them like the big picture here, it's the interest rates are going to come down, but people overall, they're going to have pay increases, which normally happens every year. And as long as the unemployment rate, right, at the rate of income and unemployment stay relatively stable through the recession, we'll still be fine, right? Okay, so yeah, so based upon all these things here, like just um, we're really trying to say that like overall we're going to see the interest rates falling, right, at least 1%, if not more. And we're likely to head in a recession, and recession correlates to improved mortgage rates, not a housing crash. And the increasing income, right, helps affordability. It's still going to be a very low inventory, tight market, and we'll see the rents are going to continue to still be expensive for people, and we should definitely be educating people on the home ownership, right? Still awake?
Yeah.
Okay, so yeah, I mean, I regurgitated a lot of information that Barry Habib, he went through this slideshow. I mean, he did it much better than me, but I just thought it was pretty powerful, uh, but anybody have anything you want to add? Or
I like a lot of the slides you showed. There was a few in there that would be helpful to help, with buyers to understand a little clearer.
I think you have to, when it comes to working with buyers, it's it's hard to promise something or to have them expect something, and if things turn around, they don't go down to 5%, then they're gonna come back to us and be like, "Hey, you told me rates are gonna go down to 5%." So I'm always careful about that kind of stuff now,
Yeah.
like predicting
Yeah.
anything about the future, like, oh yeah, home prices are gonna go up, and say
Mhm.
they go down 10% in the next year, then they're not gonna be happy. Like, so I try not to promise too many things or have them expect. It's all about managing expectations, right? Um, so I don't know, but I guess I had a lot of little comments here and there, but yeah, good presentation, Shane.
Yeah, yeah, no problem. Yeah. Yeah, I mean, I think like of course like you never want to like overpromise something somebody or guarantee, right? But we do see like me personally just looking through this in our area, we kind of live in an area that's a little bit more immune to unemployment, right? And then income seems pretty stable here. So uh, if anything, recession it'll kind of like scare away some buyers because of the fact that like, oh, we're in a recession, I got to be tight about everything. But overall, in general, like like I stopped by an open house like just to check it out, like I just after church yesterday, and there was like it was in Penderbrook, and there were like over 20 people, like it was crazy, so I think like in our area, like, I don't know, like hopefully we're not going to see like the crazy like you know the thing that we saw like a year ago where people just like putting in stupid offers. But I think overall the recession, I mean it's going to make it a kind of healthy competitive market, but I just don't feel like it's going to be as crazy as like it should be all right. I think then we'll be all right.
Was that house in Penderbrook the one that was 955?
No, it was like
Oh, okay.
it was like 675 or something.
Okay. I've been eyeballing one over there for a client. Just wondering.
Yeah, it was like buzzing in there.
Yeah.
Yeah.
Good price point. People love Penderbrook.
Yeah, and there's really nothing else out there. So, and another thing too, like I was like kind of thinking too was when their interest rates come down because of that, because we're in a good job area, then people are gonna want to upgrade too. They're gonna want to, so they'll put their houses up. So we might see a little bit of increase in inventory because of that. Yeah, and all those people that had to settle, right, during the last year, like they they had to settle for second or third choice.
Yeah.
They might be trying to upgrade too.
That's true.
Yeah. So yeah, I mean, either it's going to be a good opportunity for people to um, consolidate their debts, right, because of all the revolving debt and all that stuff. But also it's going to be a good opportunity to, I think, for the housing market for us too.
Yep.
Mm.
Cool.
All right.
All right.
Well,
So
thank
yeah,
you.
hope hope you find it helpful. I mean, I can share, any of these. Like this was like repurposed for us too. So like, if you want any of these slides, like I can, you want to share with your clients too, I'll send it to you.
Yeah, I'd like that. There's a couple I'd like to pull out of there.
Okay.
Mm-hmm.
Cool. All right.
Thank
Well,
you so much.
yeah, no problem. Thanks for your time, guys. And
All right.
yeah, looking forward to hopefully if I have anything else like coming up too, like I'll keep you guys in the loop.
Cool. Thank you.
All right, cool. Thanks, Shane.
All right.
Bye, guys.
Thanks, Shane.
Thanks, guys. Talk to you
All right.
later. Bye.
Bye.